Hey guys, I want to give you some strategies to help you with bear markets. Whether it's to do good in them or just to save yourself from doing bad in them, or maybe you want to keep investing and just some things to help you through one, right? Because so first off, what is a bear market? Well, a bear market refers to a widespread decline in asset prices of at least 20% from recent highs. Now, clearly, that's nothing that you want to look forward to, but finding back can be risky, it can be dangerous. So I kind of want to walk you through some of these important investment strategies and mindsets to help you stay calm and do good when the stock market takes, a chunk of your returns. So the first thing, and probably one of the more important things, is to keep your fears in check. Now, there is an old saying on Wall Street that Dow climbs a wall of worry. So, in other words, over time, the Dow has continued to rise despite economic woes and calamities and just all sorts of things. No matter what, over time it rises. Investors should try to always separate their emotions from the investment decision making process. What seems like a massive global catastrophe one day may be remembered as nothing more than a blip on the radar, screen 5, 10, 15 years plus down the road. Remember that fear is an emotion that can cloud rational judgment of a situation. Keep calm and carry on. The next thing is one of my favorite things, which is dollar cost averaging. The most important thing to remember or to keep in mind during an economic slowdown is that it's normal for the stock market to have negative years. It's part of the business cycle. If you are a long term investor, that's going to mean 10 plus years time horizon. One option is take advantage of dollar cost averaging. By purchasing shares regardless of price, you end up buying shares at a low price when the market is down. Over the long run, your costs will average down, leaving you with a better overall entry price for your shares. So the next thing you could do is play dead. During a bear market, the bears rule and the bulls do not stand a chance. There's an old saying that the best thing to do during a bear market is to play dead. It's the same protocol as if you met a real grizzly in the woods somewhere, right? Fighting back would be dangerous. By staying calm and not making any sudden moves, you'll save yourself from becoming a bear's lunch. Playing dead in financial terms means putting a larger portion of your portfolio in money market securities such as, certificate of deposit, right, or CDs, U.S. Treasury bills, and other instruments with high liquidity and short maturities. Another great strategy you can do is diversify. Having having a percentage of your portfolio spread among stocks and bonds, cash, crypto, real estate, alternative assets. This is the core of diversification. Now, how you slice up your portfolio, it kind of depends on you. So some of the things it's going to depend on it's going to depend on your risk tolerance, your time horizon, and your goals, right? Because keep in mind, every investor's situation is going to be different. What works for me might not work for you, won't work for your mom, won't work for your brother. Make sure you're investing, for you. Now, a proper asset allocation strategy, it's going to allow you to avoid the potential negative effects resulting from placing all your eggs in one basket. Okay. So, if you are going to invest, let's make sure that you're only going to invest what you can afford to lose. While investing is important, so is eating, so is having a roof over your head, having a bed, your car to get to and from work. It's unwise to take short term funds, your rent, your mortgage, your groceries, money for gas, and invest these things in stocks instead. As a general rule, investors should not get involved in equities unless they have an investment horizon of at least 5 years, preferably longer. And they should never invest money that they can't afford to lose. Remember, bear markets and even minor corrections can be extremely, extremely destructive. The next thing that you guys want to do is you need to look for good values. Bear markets can provide great opportunities for investors. The trick, though, is to know what you're looking for. Beaten up, battered, underpriced, these are all descriptions of stocks during a bear market. Value investors, such as the famous Warren Buffett, often view bear markets as buying opportunities because the valuations of good companies get hammered down along with the poor companies and sit at very attractive valuations. Buffett often builds up his position in some of his favorite stocks during less than cheery times in the market because he knows the market's nature is to punish even good companies by more than they deserve. Okay, well, another strategy you could do is to take stock in defensive industries, right? Defensive or non cyclical stocks are securities that generally perform better than the overall market during bad times. Now, these types of stocks provide a consistent dividend and stable earnings regardless of the state of the overall market. Companies that produce household non durables such as toothpaste, shampoo, shaving cream are examples of defensive industries because people will still use these items during hard times. One of the last strategies to talk about, which I don't really recommend people getting into if you're new in the stock market, and I still wouldn't recommend it very much, but going short, right? There are ways to profit from falling prices. Short selling is one way to do so. Borrowing shares in a company or ETF and selling them, hoping to buy them back at a lower price. Short selling requires margin accounts and could use. You're going to need a lot of knowledge, right? Because they could cause harmful losses if markets rise and short positions are called in, squeezing prices even higher. Put options are another choice, which gain value as prices fall and which guarantees some minimum price at which to sell a security, effectively establishing a floor for your losses if you're using it to hedge. You will need the ability to trade options in your brokerage account to buy puts. Now, inverse ETFs also give investors a chance to profit from a decline in major indexes or benchmarks, such as the NASDAQ 100. When the major indexes go down, these funds go up, allowing you to profit while the rest of the market suffers. Unlike short selling or puts, these can be purchased easily from your brokerage account. Okay, so what have we learned? What's the takeaway here? Nobody wants to be cut with a bear market, right? That's not what you don't want to be in one, but it's going to happen, right? And if you find yourself amidst falling stock prices, there's some strategies you can put into use, right? We talked about 7 or 8 of them here. You can take a practical and defensive posture, accumulating more shares in a regimented way as prices decline to pick up stocks on sale, right? Dollar cost averaging. You could also go on the offensive and take short positions in the market, profiting as prices decline. There's a bunch of different strategies and mindsets to keep in mind, keep at the forefront of your mind when this is all going on. So, hopefully you guys got, some good information, some good strategies. You can keep your mind clear and your emotions out of it when you're making these decisions. Hopefully you enjoyed it. If you liked the video, hit that thumbs up button. If you're not subscribed to the channel, I'd appreciate if you did. But until I see you guys in the next video, y'all be safe.